You've been told that global power comes from armies, alliances, and natural resources, but the real force shaping the world today is far quieter: an engine with no soldiers, no borders, and no visible form. It doesn't conquer nations. It makes them dependent. It doesn't raise flags. It raises interest rates, and it isn't powered by oil, steel, or land, but by something far more fragile: debt. For more than a century, the United States has operated the most influential debt machine ever constructed, one so deeply interwoven into global economic systems that every major nation relies on it to function. But this wasn't designed overnight. It grew through crises, wars, and political gambles that ultimately positioned the US dollar as the center of the global financial universe. To understand how this hidden engine works, we must travel back to the early 20th century, when America faced a chaotic financial landscape. Banks collapsed regularly, credit markets froze, and wealthy financiers, not the government, controlled the flow of money. The nation needed a stabilizing force, but what it got was something far more powerful than anyone anticipated. In 1913, the Federal Reserve was created, a central bank unlike anything the United States had seen before. Its original purpose was simple: prevent bank failures and manage currency. But over the decades, it evolved into something else entirely: a debt-creating institution capable of influencing not just the US economy, but the entire global system. The turning point came with World War II. As Europe burned and nations exhausted their gold reserves, the US quietly gained control of the world's capital. By 1944, at Bretton Woods, an agreement was signed that would make the US dollar the backbone of global finance. The world would trade in dollars, America would supply them, and every major economy would depend on the Federal Reserve's decisions, whether they liked it or not. But Bretton Woods came with a fatal promise: every US dollar would be backed by gold. As global trade expanded, the world demanded more dollars than America could back. The system was running out of metal. Countries began asking for their gold back, draining US reserves, and by 1971, President Richard Nixon made a decision that would quietly reshape the global economy. Nixon closed the gold window, detaching the dollar from physical metal. Overnight, money became purely conceptual: a promise, a ledger entry, a digital signal. And with that freedom came something extraordinary: the unlimited ability to borrow. Without gold restricting supply, the US Treasury could issue debt endlessly. The Federal Reserve could create money with keystrokes. Banks could multiply deposits through fractional lending. A new system emerged, powered by constant borrowing and perpetual expansion. This was the birth of the modern US debt engine. At first, it appeared harmless. Debt fueled development, infrastructure, research, and global trade. But soon, borrowing became not a tool but the foundation. Money itself became debt, created through loans, circulated through interest, and demanded by countries seeking stability. So how does the hidden debt engine actually work? It begins with Treasury bonds, the financial lifeblood of the global dollar system. When the US issues bonds, investors, banks, and foreign governments buy them. This gives the US money to spend, while buyers receive interest. But here is the twist: the Federal Reserve can buy those bonds too, creating money out of thin air. This means the US can finance wars, stimulus packages, and economic rescue operations simply by expanding its balance sheet. No other country on earth has this privilege at the same scale. And the world accepts it because all major markets need dollars to function. As global trade expanded, the demand for safe assets grew. Nations needed something stable to store wealth and conduct business. US debt became that instrument. The more they bought, the more America could borrow, and the deeper the world became tied to the US engine. But debt engines require fuel: constant borrowing. The US must run deficits every year to supply the world with dollars. If America stopped borrowing, global markets would shrink, liquidity would vanish, nations wouldn't have enough dollars to trade. The system survives through expansion, not stability. By the 1980s, debt replaced taxes as the primary funding mechanism of the US government. Politicians learned they could promise growth without raising taxes by simply increasing borrowing. The Federal Reserve learned it could stimulate markets by lowering interest rates. Wall Street learned that leveraging debt created exponential profits. The debt engine was no longer a tool, it was the economy. But every engine has a breaking point. The first major stress test came in 2008, when the housing market collapsed under the weight of synthetic debt. Banks failed, Credit markets froze, and global trade nearly shut down. Yet instead of allowing the system to contract, the U.S. debt engine did what it always does: it expanded. The Federal Reserve created trillions of dollars, bought toxic assets, and dropped interest rates to near zero. The debt engine was saved at the cost of future stability. The next shock came in 2020 during the pandemic. This time, the Federal Reserve printed more money in a single year than it had in the previous decade. Government debt surged, corporate debt soared, personal debt skyrocketed. The engine was not only running hot, it was overclocked. Today, the U.S. national debt exceeds $35 trillion, and global debt exceeds $320 trillion. But despite these astronomical figures, the system continues functioning because the world has no alternative. The U.S. debt engine doesn't just power America, it powers international banking, trade, investment, commodities, and global liquidity. Many ask, why doesn't the U.S. collapse under its own debt? The answer lies in the structure of the system. The U.S. pays debt in the very currency it controls. As long as the world demands dollars, the engine survives. It can refinance, restructure, and roll over debt forever because the global economy requires it to. But this creates hidden consequences. Inflation quietly drains purchasing power. Interest payments consume increasing portions of government budgets. Currency debasement punishes savers while rewarding borrowers. Ordinary citizens bear the cost, while financial institutions profit from the system's design. The engine also creates a dangerous dependency. Nations hold trillions of dollars in U.S. assets. If they sell too quickly, their own currencies collapse. If they hold too long, inflation eats their reserves. The world is locked into the system like passengers on a ship that cannot dock. Attempts to escape the dollar have repeatedly failed. The euro crisis destabilized Europe. China's capital controls weaken investor trust. Cryptocurrencies lack the scale and stability to replace sovereign money. The U.S. still provides the most liquid, trusted, and scalable debt market in history. But reliance is not the same as safety. The system grows more fragile as the engine accelerates. Higher interest rates increase debt costs. Political gridlock threatens default. Inflation erodes trust. And each crisis requires even more debt to fix the damage caused by the last one. This creates a repeating cycle: crisis, expansion, temporary stability, and a return to crisis. Each loop requires more money, more borrowing, and more intervention. The engine grows, but so does the risk. What happens if interest rates stay high? What happens if global demand for U.S. debt stagnates? What happens if the U.S. cannot refinance at the speed markets require? These are the pressure points no government openly discusses. And yet, the system continues, because collapse is unthinkable. The world would rather tolerate high inflation, rising debt, and currency erosion than face the alternative: a global financial vacuum. The hidden truth is that the U.S. debt engine is not simply a financial mechanism, it is a geopolitical tool. Through debt, the U.S. maintains influence over international institutions, global trade routes, and capital markets. Debt is not America's weakness, it is its leverage. But this leverage comes at a cost. Every dollar created reduces the value of those already in circulation. Every expansion shifts wealth upward. And every crisis accelerates dependence on a system that cannot slow down. The story of the U.S. debt engine is not one of villains or heroes, but of design. A system built to solve short-term crises that accidentally created long-term dominance. A structure that relies on continuous belief in the dollar, belief in U.S. stability, belief in debt itself. The question now is not whether the engine will stop, but what happens when people finally understand how it works. If you want to uncover the mechanisms shaping your financial future, subscribe, share this video, and help expose the system hidden in plain sight. Because the engine thrives in silence, and it's time to make noise.